Most people believe credit scores move slowly. They're told to pay on time, avoid mistakes, and wait patiently while the system builds trust. Years go by, nothing dramatic happens, and somehow they still pay more for the same life than other people. The difference isn't discipline or intelligence. It's understanding how the system actually works. Here's the uncomfortable truth. Credit scores don't reward patience. They reward structure. Two people can walk into the same bank on the same day, and one of them will quietly give away hundreds of thousands of dollars over their lifetime. Not because they're reckless, but because they don't know how credit really measures risk. Once you understand that, the idea that improvement must take years stops making sense. The biggest misconception about credit is that progress is naturally slow. People assume time itself is the main ingredient. Open accounts early, behave well, and eventually everything works out. That advice sounds reasonable, but it hides an important reality. While you are waiting, the system is charging you higher interest rates, worse loan terms, and more expensive access to money quietly drain your future. Credit scoring does not work on a smooth scale. It works in tiers. Being almost excellent still means you are treated as risky. You might qualify for loans, but you do not get the best pricing. That gap is where banks earn the most. Borrowers in the middle pay more interest while still being reliable enough to approve. From a business perspective, they are ideal customers. This creates a silent penalty that compounds over time. A slightly higher rate on a mortgage doesn't feel painful month to month. But over 30 years, that difference can reach six figures. The same applies to car loans, credit cards, and even insurance premiums in many regions. These costs don't announce themselves. They slowly erode wealth. Banks have no incentive to explain how to escape these tiers quickly. Faster improvement means less interest collected. So the common advice focuses on long-term behavior and patience. It isn't false. It's incomplete. It ignores the fact that credit scores are mathematical models reacting to data, not moral evaluations of effort. A credit score is a prediction. Algorithms analyze patterns from millions of. They don't care why your profile looks a certain way. They only care that it resembles low-risk or high-risk groups. That means when certain data points change, the prediction can shift rapidly. Most people assume credit history equals time. If your oldest account is young, you think you're stuck waiting. But the system doesn't see time the way humans do. It sees averages, ratios, and imported history. When those numbers change, the score recalculates immediately. No patience required. Imagine a borrower trying to buy a home. She qualifies, but her credit score places her in a mediocre category. The lender offers a rate that is noticeably worse than the best available option. It doesn't look catastrophic on paper. Just a small percentage difference. Most people accept it without question. Over the full length of a 30-year mortgage, that small difference becomes enormous. The borrower ends up paying well over $100,000 more in interest. Not for a better house. Not for better service. simply for access to money under less favorable terms. She asked for time before locking the rate. 90 days. The response is polite but dismissive. Credit scores don't change that fast, she's told. Improvement takes years. She's advised not to expect anything meaningful to happen in such a short window. What changes during those 90 days isn't her income. She doesn't switch jobs. She doesn't suddenly save a massive amount of money. Her spending habits don't radically shift. The house she wants stays the same. The only thing that changes is the structure of her credit profile. When she returns, her score isn't slightly better. It has crossed into an entirely different tier. The lender now views her as low risk. The interest rate drops dramatically. The loan becomes far cheaper over its lifetime. The system didn't reward patience. It responded to new data. Now consider a younger borrower. He made mistakes in the past. Missed payments. High balances during a difficult period. Nothing extreme, but enough to label him risky. When he tries to finance a used car, every offer comes with a painful interest rate. He hasn't suddenly become irresponsible. His profile just signals uncertainty. Lenders protect themselves by charging more. He qualifies, but he pays a premium for his history. This is how the system prices risk. Then one structural change occurs. No new loan is opened. No major debt is paid off. His income doesn't increase. Within 2 billing cycles, his credit profile looks completely different to the algorithm. His average account age jumps. His available credit increases. His utilization ratio drops sharply. The system now compares him to a different group of borrowers. The prediction changes, even though the person hasn't. When he returns to the dealership, the offers are unrecognizable. The interest rate is dramatically lower. Over the life of the loan, he saves thousands of dollars. Not because he matured financially in 2 months, but because the system reclassified him. Many responsible people are confused when their credit score drops despite doing everything right. They pay cards in full every month. They avoid interest. They behave exactly as advised. Yet their score fluctuates or even declines. The reason is timing. Credit reports capture snapshots, not intentions. Utilization is calculated when balances are reported, not when payments are due. A card can look heavily used on paper even if it is paid off days later. It does not care that interest was never charged. It only reacts to the reported balance relative to the limit. Once timing is adjusted and balances are reduced before reporting, the score responds quickly. No lifestyle change is required. No new habits are formed. The math simply changes. The fastest improvements come from adjusting the inputs credit algorithms value most. One of the strongest is history. When long, well-managed history becomes part of your profile, averages change immediately. The system does not wait years to react. Another powerful lever is utilization timing. Lowering reported balances before they are captured can produce noticeable changes within a single cycle. This is not about spending less. It's about when numbers are recorded. Increasing credit limits also changes the equation. Higher limits reduce utilization without changing behavior. Spending stays the same, but ratios improve. The system interprets this as lower risk. These mechanisms exist by design. People realize they could be used intentionally. Nothing illegal. Nothing hidden. Just rarely explained. Credit feels slow only when you rely on slow levers. When you understand what the system actually measures, progress accelerates. Credit scores are mechanical models responding to data, not moral judgments of effort. Once inputs change, outputs change. Immediately. People who understand this pay less for the same life. Lower interest. Better terms. More options. People who don't quietly overpay for decades. The system isn't broken. It's just optimized for lenders, not education. Understanding the rules doesn't mean cheating. It means playing the game with awareness instead of assumptions. Most people believe credit scores improve slowly because that's what they've been told their entire lives. After hearing this, I want to know your opinion. What do you think is the biggest myth about credit? That time matters most? That effort alone is enough? Or that the system is intentionally confusing? Write your answer in the comments. I read them all. And the best insights often become future videos.